Big changes in the S&P 500. The annual reclassification of the index is taking place today at the close. Several stocks are moving to new sector categories, and that could have a big impact on your portfolio. Our Bob Pisani joins us now with the details. Bob, great to have your insight on this, but I thought you were going to be here, Bob. You left me standing or hanging.
Well, you know, we got a lot of different things we're doing in different parts of the world, Frank. This story is very interesting because the index gurus are at it again. Some of the most well-known stocks are getting reclassified today, and that means a lot of money is going to be moving around at the close. So in a display of common sense by S&P, Target and Dollar General and Dollar Tree are going to move out of consumer discretionary and join Walmart finally as consumer staples at the close. Strangely, you know, Frank, Visa, MasterCard, and PayPal seem like financials, right? But they're actually listed as technology stocks. That, too, is going to be changing at the close today. They will move finally into the financial sectors, arguably where they belong. For those who just own the S&P 500, that is not going to affect you. But for those of you who trade sectors like financials or bank stocks, it's going to change the weightings. So financials, for example, will be a bit bigger at the close. Technology will be a bit smaller. It's all part of the annual reclassification of the S&P 500 and dozens of other indices as part of an agreement brokered by the two biggest index providers in the world. That's MSCI and Standard & Poor's, S&P. They 25 years ago, almost 24 years ago, set up an industry standard. It's called the Global Industry Classification Standard, GICS, that splits all the world into 11 sectors, 24 industry groups, 69 industries, and 158 sub-industries. That's why we use words like, for example, energy stocks or consumer discretionary. All this was an academic exercise 25 years ago. Before that, that was before the triumph of the ETF business and the triumph of indexing. Now, there's now north of $6 trillion indexed to just the S&P 500 alone. So any movement of stocks involves moving money from one sector to another. These are not fund managers, the people who do this. They're index providers. But Frank, don't let that fool you. In a world where people buy funds that are tied to indexes, the people who determine what go into those indexes have become very powerful indeed. Frank, back to you.
All right, Bob, thank you very much. So, Joe, I'm going to come to you first. We were just actually chatting before the show about the move of MasterCard, Visa, and PayPal into financials. You also hold those in the Joe T ETF. What's that going to do for you?
Visa and MasterCard.
Visa and MasterCard, excuse me.
Not PayPal. So 11 companies are going out of technology, and what's significant here is a little bit of a transformation for the financial sector. By bringing two companies with $300 billion plus market caps in Visa and MasterCard, you're really diversifying the top 5 or even the top 10 holdings in the financials away from traditional banks. And I think it's one of the reasons why I personally bought MasterCard the other day. I had already personally owned Visa. But I believe that now you could look at the financial sector, to Bob's point, if you are playing sector ownership and say, okay, I don't want to necessarily be in the big banks or the regional banks. I get a little bit more diversification within the sector. Visa and MasterCard will be the third and fourth largest weightings within the sector now, pumping down a lot of those banks.
Yeah, big change. Rob Sechan, you also own MasterCard or Visa. Big deal, little deal?
A thank God deal, because I've had to explain to clients why we're overweight tech, and I come on the show and talk about how we don't like tech, and it's because of our ownership of Visa and MasterCard. Frankly, I think it's ridiculous that the payments are payment providers are categorized within technology. So to me, that's a real positive. Some of the other changes perhaps will lend a little bit more support to those areas as they're moving to consumer staples, and I think that's going to be you know, in a risk-off market, that's going to provide some support. So I'm happy about this change.